Top of the morning to you, and welcome to our newest episode of Capital Markets Quickie from MVP Mine Value Partners. The market rotation out of the technology sector and into more cyclical stocks continued as the vaccine developments improved investor sentiment and confidence about next year's outlook. Market rotation, what it is, what drives it, and whether it will last, that's going to be our topic today. My name is Endrit Cela, coming at you from Frankfurt, Germany, Europe's financial hub and home to the ECB. Let's take a closer look at what moved the markets this week. A central theme in the equity markets over the last 2 weeks has been the so-called market rotation, or you can call it the change in leadership across asset classes, sectors, and investment styles like growth and value, for example. We received a series of positive vaccine announcements, first from Pfizer on November 9th, then from Moderna last Monday, and then from Pfizer again last Wednesday on the final result of its late-stage trial. So this is definitely a sprint to the finish line, and it's only a matter of weeks, who knows, maybe even days before we hear the great news. This, of course, propelled the S&P 500 to new all-time highs before the rally fizzled later in the week on deteriorating coronavirus trends. States and local governments across the United States are once again locking down the economy, and therefore the near-term economic outlook is worsening because of the renewed restrictions on all kinds of activity. As the market attempts to balance expectations between the near-term outlook against an improving medium to long-term outlook due to the vaccine developments, we've noticed a tug-of-war between the year-to-date leaders and the economically sensitive investments that have lagged so far. So here are some thoughts on the recent market rotation, its drivers, and its sustainable potential. For starters, we've seen that the winners and losers have traded places. Technology stocks, growth-style investments, and stocks that have benefited from the stay-at-home trends not only held up better during the pandemic-induced bear market, but have also led the market since the March bottom. However, the recent vaccine developments acted as a catalyst for the recent shift in the investment landscape as confidence in the economic rebound has strengthened. Cyclical sectors like energy and financials, which have been negatively impacted by the pandemic and are more sensitive to the reopening of the economy, well, they have outperformed, while sectors that have benefited from the pandemic, like technology and communication, well, they have lagged. A similar rotation occurred across asset classes, with small cap and international investments outpacing US large cap investments. Investment styles were affected too, with value, such as dividend income, outperforming growth, which is mainly capital appreciation. And one thing is crucial here. Economic growth and interest rates are the key rotation ingredients, and very important if this market rotation is likely to be sustainable. So when economic growth is slow and interest rates remain low, investors tend to favor companies with the ability to grow earnings at a faster pace than the market. And these companies typically trade at higher valuations, like stocks in the tech sector. And while that was the case over the course of the last bull market from 2009 to early 2020, this bull market was characterized by slow growth, low interest rates, and subdued inflation, and that is why growth stocks did so well. And on the flip side, accelerating economic growth and rising interest rates benefit sectors like industrials and financials, both of which are heavily weighted in international small cap and value indexes. And that would be the likely scenario coming out of the corona crisis, especially with the vaccine just around the corner. Well, I believe there is a good chance that next year will showcase investors the benefit of owning a properly diversified portfolio with exposure to not only in US large tech stocks, but also value small caps, international and cyclical sectors that have been the clear losers this year. As confidence about the return to normal economic conditions increases, and as the expansion facilitated by medical solutions extends into the future, I anticipate additional rotation into economically sensitive and cyclical investments. And with that being said, I doubt the rotation will be consistent or uninterrupted. Even the last bull market, which I already touched on, wasn't uninterrupted and had many instances of market rotation, which is why I recommend investors maintain appropriate diversification in their portfolios. And that, ladies and gentlemen, concludes today's Capital Markets Quickie. To all of you listening from every corner of the globe, I wish you all the best and stay tuned for our next episode on Sunday, November 29th.